Good morning. All the best for 2023. It is great to be with you again. Our cautiously optimistic strategy has worked well. The funds are up 17% in the last 3.5 months, including over 5% so far in January alone. In fact, the markets have done more in January this year than the entire of 2022. Long may it last. Of course, that was the easy money. 2023 is going to be more difficult. But before I go into 2023, let's review 2022. So 2022 was one of the toughest years in a century. In fact, we maybe shouldn't have been so quick to wish 2020 away, because 2022 makes 2020 look easy. $14 trillion of wealth disappeared from global markets amongst 300 interest rate increases last year. US tech stocks were the worst performers. You can see there in green, fourth IR and FAANG down 27% and down 36%. A really tough year for US tech stocks as US inflation and interest rates went up. On the other side, dollar cash and gold performed best, followed by healthcare. And I'll talk more about healthcare and FAANG later on. Value continued to do very well, with the average US large cap value fund only down 6% compared to growth average funds down 50%. And if you look at value there, also in green, down 3.5%, pretty good return in rands, and the FTSE 100 or the UK equities are flat in rand terms. So again, both those value proxies doing really well in 2022. So we remain overweight value. Global balanced portfolios were dragged down by both bonds and equity, with the average US equity mutual fund finishing down 17% last year. It's a really tough year for global balanced portfolios. Fortunately, South African balanced portfolios doing a lot better, with South African equities having a small positive return, 3.7%, and South African bonds having a small positive return, 4.2%, and overall leading to a small positive return for South African balanced funds. Much better, nearly 20% better than global balanced portfolios. Still not a great return, but at least it was somewhere to hide relative to the devastation that happened in global markets. How did this impact the funds? We're looking over 12 months, so reviewing 2022. Pretty tough returns. You can see that none of the returns in double digits. The best return was from the Sygnia Health Innovation Fund, 9.4%. And showing that value and healthcare continue to do well, with the Divi Fund in second place at 7.6%. And then the bottom of the log there, 4 and 5, both global funds showing the weak rand helping our portfolios quite a lot. In the short term, looking at December, you can see the South African equities and China bouncing back really nicely. And China has continued to bounce this year, as of South African equities, as is all markets over the last 3.5 months. Basically, Q4 2022 and going into 2023 has been a really great start to the year. So a nice bounce, but overall, just recovering from incredibly tough lows, incredibly low lows. 2022 was a tough year, and yeah, let's see what 2023 looks like. So let's talk about the US. The US being the largest market in the world, the driver of all other markets. When the US sneezes, well, the rest of the world catches a cold, so they say. And is that going to happen this year? Well, certainly the world seems to think that the US is going to sneeze. The Conference Board leading economic indicator for the US is flashing recession. So this indicator is incredibly accurate once you fiddle it to make sure it fits all the back test data as well as it can. But if you do that, and if you make sure that this index falls into negative territory for 2 months in a row, well, then it's forecast every recession that's happened in the last 50 years. It's pretty impressive. Of course, the lead time varies from as little as 3 months to as much as 24 months. But if you have to take an average lead time of 7 months, this indicator says that the US is going into recession in March this year. Now, if you look at the yield curve, if you look at PMIs and other indicators, they all seem to agree that the US is going into recession this year. In fact, the US recession for 2023 is the most widely forecast, most consensus, most well-telegraphed recession of any recession in history. So it's definitely what the market's expecting. And we're along with the market. We think the US is going to go into recession. But firstly, it's going to be a mild recession. And secondly, we think it's going to happen towards the end of the year, Q3, Q4, and not in the beginning of the year. And that's very important to 2023's overall outlook, looking at when different geographies, different economies, different countries are going to slow down, and which ones are going to recover at what time will have a huge impact on how the entire global GDP recovers and how stable markets are and what returns we expect from various markets. So that timing is crucial. And we think that the US, while it will slow down, it's not going to happen in the first quarter, but more likely in the fourth quarter of 2023. So why do we forecast a slowdown in the US? Well, same as most people, because the Fed has been incredibly hawkish. Here you can see Jeremy Powell talking about unwarranted easing in financial conditions. So right now the dollar has weakened slightly and markets have recovered, which does ease financial conditions. He's saying markets mustn't get ahead of themselves. Markets mustn't think that all the pain is behind them. In fact, he's saying that labor markets are extremely tight, and he's suggesting that labor markets need to soften and that some more pain must be endured before we can start the Fed can start to ease rates. And the longer we delay, the easier things are now, the more painful it's going to be. And if the Fed doesn't act strongly now, and if markets ease too much ahead of the Fed, well, then the Fed's going to be forced to hike more, hike longer, or hike faster. So once again, the Fed doing what it's supposed to be doing, using tough, hawkish rhetoric to talk up interest rates so that it doesn't have to push the economy into a recession this year. But we think it is inevitable. So let's look at the US. What happened in the US? Well, inflation continues to fall. It fell in December to 6.5%. So that's as expected, and markets rallied on the results on the back of that. Dollar weakened on the back of that. And inflation expectations remain well anchored. So things are looking good from an inflation perspective, and we think that inflation will continue to fall this year in the US. Meanwhile, the Fed has its highest rates since 2007, 4.5% US interest rates after 50 basis point rate hike in December. 4.5%. That's a really, really high dollar interest rate yield, and that's one of the reasons why the dollar was quite strong last year. And the Fed's forecasting that interest rates are going to go up another 50 basis points this year to just over 5% by the end of 2023. So is that going to happen? And why will that happen? Well, if we're looking at the US market, one of the things I forgot to mention is that if you look at continuing claims, it's at 28%. Now, when that's happened in the past, and it's happened 7 times over the last 6 years, every time continuing claims have been above 28%, above its 1-year low, that's resulted in a recession. So quite interesting, continuing claims is talking about the jobs market, and the jobs market isn't actually as tight as markets are worried about. Yes, it is tight, but it is also flashing recession. Doesn't mean it's not going to get tighter, or doesn't mean it's going to stop the Fed from hiking, but it is also flashing recessionary signals. So definitely recessionary signals are on the way. But what is the cause? Well, the thing is that the consumer is still very strong, and the consumer is going to carry on spending. So despite interest rates going up, if you look at the charts on the right there, the US consumer has already drawn down $800 billion of excess savings from COVID, but they've still got another $1.5 trillion of excess savings that happened during COVID. And that just talks about pent-up demand, savings or income that couldn't be spent because of lockdowns, because of low mobility. And that really will support the economy this year across the world, but in the US as well. You can see there $1.5 trillion. But that means that because the consumer is more resilient, interest rate increases are going to have a smaller impact than they would have had in the past. And interest rate increases also take time to work. So we think that inflation is going to stay higher for longer. Rates are going to stay higher for longer. And while the Fed does need to panic because inflation expectations are well anchored, we still think there'll be another 25 points hike in February and possibly another 25 points later in the year. And that's because inflation is not going to have a chance to, yes, it's falling quickly, but it's not going to get down to the target as quickly as the Fed wants, because the consumer is strong and because there's still this supply-demand imbalance in the US. So if you look at Chinese inflation, it's been relatively well contained. Japanese inflation, relatively well contained. European inflation has been horrendous, but that's been driven by high energy prices. The US inflation has also been horrendous, but they haven't had the same high energy prices or the same energy crisis that Europe's had. What they did have was a much bigger COVID supply-demand imbalance. First of all, there was way too much COVID support and a lot of printing of money that happened during COVID, but also because of the weak labor markets and labor unions, a lot of people fell out of the job market during COVID, and they haven't come back. And it looks like, particularly people above the age of 50, they've decided that they're not going to come back into the labor market, and that's led to the supply demand in terms of labor, and that's one of the reasons why inflation is likely to stay elevated in the US. There are, of course, a host of other issues that are plaguing the US right now, and we are under it, the US. The big issue for us is the dollar. We think the dollar will continue to weaken, but there are a number of other ones. Antitrust issues certainly remains a big headwind for large cap US tech. China led the way there, but we think that the US will follow. And then I'm sure you've all followed what's happening with the Republican Party and Kevin McCarthy, but it's been a bit of a dog show. And the amount of concessions that Kevin McCarthy had to make to keep his seat, and the concessions or deals that were made with the far right Freedom Caucus certainly lead to some concerns. We've got the debt ceiling deadline coming up on January the 19th, and we could be in for another US government shutdown. So definitely a number of risks facing the US this year: higher inflation, debt ceiling shutdown, antitrust issues, a weaker dollar, and all of those lead us to maintain our underweight to the US. And our US exposure that we do have is very much focused on value. We think value will continue to do well in the higher inflation, high interest rate environment that the US is seeing. So overall, the US is going to slow down. It is going to have a mild recession towards the end of the year because interest rates will stay higher for longer. The consumer is strong, but eventually that consumer is going to have to be curtailed with more interest rate increases to get inflation down properly and sort out the labor market. So let's move on to Europe. So we remain neutral. The EU, we do think that the euro can continue to rally, and that's on the back of a hawkish ECB. So here you've got Christine Lagarde talking about financial markets underestimating the necessary rise in borrowing costs. Basically, like the rest of the world, there's an underestimation of how much interest rates have to go up. And the ECB has been hawkish. They've already hiked 50 basis points in December for a total of 250 basis points of hikes so far. But more hikes are definitely on the way. And the good news, and I think this is very important, the good news is that the European economy can actually handle those rate hikes, and that's why they are likely to happen, because growth is certainly recovering very nicely. Europe, funny enough, and we were all very concerned that it was going to go into deep recession last year because of the energy crisis. In Q3, which is the latest GDP data we have, in Q3 of last year, Europe was the strongest grower out of the developed market world. GDP grew faster than the UK, faster than Japan, faster than the US. So it's been a lot more resilient than we think. It is currently slowing down, yes, and it might go into a mild recession, soft landing as we speak, but it's going to recover strongly into 2023. And if it is in a recession, that recession will happen will probably happen now in Q1 of 2023. Again, very important, different regions are having their slowdowns at different times. So why is Europe going to recover nicely in going into 2023? Well, it's all about the energy crisis and the fact that the energy crisis has passed. It's been nearly a year since Russia invaded Ukraine, and Europe's had a year to recover and to reorganize, and it's done incredibly well in that regard. If you just compare how quickly they have moved into coal, into renewables, solar over 10 months, it's phenomenal. Compare that to South Africa and how slowly it's taken us to rotate into anything from coal and to try and save us from load shedding. Well, it's abysmal, but Europe's done really well. So firstly, they've been lucky, and they've had an extraordinary heat wave. The temperature rose to 20 degrees Celsius in Poland on the 1st of January. And any of you who are lucky enough to go skiing in Europe over the last few weeks would have known that there was hardly any snow and many of the resorts were closed. Certainly fantastic news for energy usage, not as great for global warming. But beyond the extraordinary heat wave, there was also consumption cuts and strong government intervention, which helped avoid the energy crisis. In Germany, 75% of companies reported being able to cut gas usage without having to cut production. So just doing things smarter, more efficiently. Gas was cheap, so they used as much as they wanted. Now gas is expensive, and they're starting to use it more efficiently, which is fantastic. No impact on output and managing to cut input. At the same time, Germany managed to add the equivalent of the entire UK's LNG stockpile to its storage in the last 10 days of December. Just a phenomenal turnaround there in terms of how quickly Germany has been able to ramp up new storage facilities. Also switching to coal, Europe's coal consumption in 2022 has pushed global coal usage to record highs, more than 8 billion tons. So again, amazing how quickly they have been able to switch from gas to liquid natural gas, from gas to coal, from gas to solar. Europe's gas stockpile stocks as a result are 14% above their 5-year average, and gas prices are now at 10-month or 11-month lows, back to pre-Russia-Ukraine war, which is again just phenomenal. So the headwind that Europe faced last year is now behind them. Yes, there are still risks. Yes, the Russia-Ukraine war is probably going to last for years, but the major supply shock that happened on the energy side is most likely behind them. And we're seeing that inflation is falling nicely from 10.1% to 9.2%. And the EU is likely to see the fastest falling inflation in developed markets as well, because of the fact that the energy prices pushed their inflation so high. And that's very, very fast to fall out. Compare that to the US. The US, yes, there were some energy inputs that caused inflation there, but it was more structural demand supply imbalance on the labor side that's causing inflation. And that, while it is rolling over because a lot of supply is coming back online, it's going to take longer to roll over because of the supply demand imbalances. Meanwhile, ironically, the EU with the very, very, very strong labor markets and labor unions, they didn't lose as many people during COVID, but for the same reason, those people are still in the labor force now that production is ramping up, and they aren't seeing the same wage pressures that the US is facing. So it looks like the EU did remain resilient in 2022, more than people thought, and is likely to remain resilient in 2023, probably going through its slowest point right now, and it's going to recover. Chart on the right just shows a similar story. Excess savings that were built up over the last 2 years, partly because of COVID, mostly COVID, but also last year when people were saving money ahead of the energy crisis, worried that they might have to spend a lot more on energy this winter than they've ever spent before, but they didn't have to. Energy prices fell, the heating usage was a lot lower than expected, and so they've now accumulated 900 billion euros worth of excess savings. So again, that can be used to make sure that the EU recovers nicely this year and doesn't go into a recession again, or doesn't go into recession at all this year. So a good solid point for the EU. EU is also likely to benefit from China's reopening, and as a result, we remain neutral on the EU from an equity allocation. Things haven't been as bad as they thought, but there are still it has also recovered quite quickly, and we think that growth is still slow in the EU. While it's not going to go into recession, it is going to be a slow burn. Let's talk about China. China has been the surprise, the dark horse over the last month. It's definitely been the black swan event on the upside, and the complete reversal of the zero tolerance COVID policy has led to a massive reopening in China. Also, a huge wave of COVID infections. And that's seen the Chinese economy firstly slow down slightly because of the infections, but also open up quite quickly. So despite that huge surge in COVID infections, almost all tier 1 cities have passed their peak COVID infection levels, and China as a whole was expected to have passed its peak COVID levels on the 13th of January. So it's past its peak. That wave is inflection wave, Omicron wave, is expected to fall quite rapidly. There were concerns that the new variant was going to be more dangerous than the previous Omicron variants, but it seems that so far it's okay. And as a result, China is opening up mobility, and people are getting back to work, and the economy is recovering very, very, very quickly. So markets as a result have jumped incredibly quickly, and that's surprising that we saw for 2022 as a whole, despite the fact that China at one point was the worst performing market of the year during 2022. End of the year looking not too bad. Yes, down, but not as much as US tech stocks. It wasn't down as much as global property stocks. So that rally helped it recover, and it's continued to rally now in the first quarter of 2023. And we think that there's more recovery to come as the reforms and the opening up and increased mobility in China help the economy grow. Yes, definitely still risks. There's the risk of US-China geopolitical risk. There's a risk with Taiwan. There's also a risk of a second wave, COVID wave happening. But we don't think that even if there's a strong second wave, we don't think that's going to lead to increased lockdowns. And China is learning to be like the rest of the world and just live with COVID, live with vaccines, live with masks, and not lock down the population. So that's the good news. The bad news is that the US-China tech war has ratcheted up a bit. The US government blacklisted another 36 Chinese corporations, and Japan, well, they managed to twist Japan and Netherlands into siding with them. So far, there's almost a complete ban of leading edge, cutting edge chips imports into China. And that certainly raises the game plan and raises the risks for US-China trade wars. So what does it mean? Well, it means that it's going to be tough for US, and it's going to be tough for Japan and Netherlands. I mean, China is one of the world's largest importer of chips, and not being able to import those chips is certainly going to lead to demand destruction for those companies and those countries. And it's certainly debatable whether it's going to be sustainable. So already we're seeing Japan starting to waver about whether they are going to hardline this export to China. At the same time, China is already self-sufficient in low-end semiconductors. All the semiconductors that are needed for consumer electronics, cars, phones, they're self-sufficient. So it will take a bit of time, but China can quite quickly move from importing to local production. A lot of government support and funding is going into ramping up local production on low-end chips. So that'll support Chinese companies, it'll support the Chinese economy, and it'll at the same time hurting other countries and other chip manufacturers. Long term, it might lead to an acceleration of chip manufacturing everywhere, but in the short term, it's certainly more beneficial for China than it is for other countries. So what does this mean for China in terms of global supply and global supply chain? Well, despite the US playing hardball against China, China remains the dominant player in global supply chains. In fact, over last year, China increased its market share of global trade by shifting exports away from the US and to Germany and the EU, but also to emerging markets as a whole. The major beneficiaries are Vietnam, Taiwan, India, Korea, Thailand, and Malaysia. And it's one of the reasons why we're happy to stay overweight emerging markets, is that shift of supply chain away from China, at least from a US perspective, away from China and towards other emerging markets. We'll see other EMs continue to do well, as well as China continue to do well. And it's only going to fast track China's local production. So we think that while it does disrupt everything in the short term, and it is a risk in the short term, it's long term, it should be fine. But generally, like the EU, like the UK, like the US, we think that the major reason to be bullish in China and be overweight China is the consumer. The Chinese consumer has been locked down far more than the rest of the world. Chinese consumers have been locked down for nearly 3 years, and that has led to a huge pent-up demand and huge excess savings, and those are going to be drawn down upon. And BCA estimates that even if only half of that savings are used, spent in 2023, it's going to lead to a full 1% increase in China's GDP this year. So we're starting to look at a China resurrection in 2023 as a result of the consumer spending. Compared to the US, where we might actually see the end to, or at least a pause in US exceptionalism as a result of antitrust, as a result of the debt ceiling, and as a result of higher inflation, or stubborn inflation in the US. So probably a reversal of what we've already seen over the last 3 months, a reversal with the US weakening and China, emerging markets, and Europe and Japan recovering. But we think that that's likely to continue. Pause in US exceptionalism driven by a resurrection in China because of the very strong pent-up consumer demand. So, looking at South Africa, well, fortunately, Finance Minister Enoch Godongwana got his prayers were answered. And Cyril managed to remain president of the ANC and of South Africa. And here you can see President Ramaphosa saying that we basically need to deal, or the ANC needs to deal with corruption, or they're going to perish as an organization. And that's certainly essential. And we really hope that reforms are on their way. We really hope that Eskom as a starting point can be fixed and that load shedding can end soon. And going into looking at the results of the ANC elective conference, things look quite bullish. Ramaphosa won 5 of the 7 top seats in the NEC, and according to Daily Maverick, 57 of 80 NEC members are his supporters, compared to less than a third of new NEC members are allies of defeated Zweli and Kizi. So the thinking was it should be relatively easy to get reforms happening this year, but it seems that political gridlock is once again slowing down recovery at Eskom, and things are still looking tough there. So despite emergency meetings and despite Cyril not going to Davos this year to try and stay behind and fix things, Eskom, we still have not seen any concrete signs of how, or plans at least, of how Eskom is going to be fixed and how things are going to turn around. And we remain underweight South African equities. I think it's quite easy to understand why. So South African economy has been in its longest downward cycle since 1945. It's, again, just an incredible number. Longest downward cycle since 1945. World Bank cut this year's economic growth forecast to 1.4%. It's just an abysmal number, 1.4%. The SARB estimates that load shedding saved 1% of GDP in 2022. That's also just tragic. But in fact, the impact on the South African economy is tragic, from farmers to retailers to individuals to the economy as a whole. It is really tragic. The scary thing is that at stage 6, the energy availability factor is less than 50%, far below Eskom's target of 75%. If we think about it, just looking at the numbers, Eskom's got roughly 48 gigawatts connected to the grid. Right now, half of that, just over half of that, is offline. 6 gigawatts for planned maintenance and 18 for unplanned maintenance. So half of that is offline. But Eskom's still paying all the costs associated with that half that's not working. They're paying hopefully maintenance costs and refurbishment costs, but certainly they're paying salaries, input costs, management costs, rentals, whatever it may be. The cost base is sitting there for that. So the quickest way, and NERSA has just put through an 18.65% interest rate hike, the highest in 10 years. Eskom wanted double that. But inflation is less than half that. So what is the issue? Well, the issue is that there's just no revenue. If you think about it, if the revenue is 10 and costs are 10, because Eskom's revenue is now down to 5, that cost base is double relative to revenue base. So obviously they need huge increases. How do you halve the cost of electricity in South Africa? Well, you either shut down those 24 gigawatts that aren't being used, just get them out of the cost base, and so that revenue matches expenses, or you get those plants up and work again, and you basically double revenue. So the issue that why costs have to go up so much is because of the fact that you've got the same cost base with half the power coming out. It is quite tragic. So why aren't the plants working? Well, look at the charts on the right. And this was some analysis by Daily Investor, and they looked at 2 US coal-based plants of similar age and similar size to South African Eskom plants, so the Eskom Tutuka and Duva plants compared to US Wainsley and Shearer. And you can see there that over that time period, the blue and red lines, the energy availability factor improved for the US plants, while plummeting for the South African plants. So it's not about the age of our infrastructure. It's all about other factors: poor maintenance, mismanagement, lack of skills, corruption, but it's definitely not the age of our plants. And in fact, the average age of US plants is nearly double that of South African plants in terms of before they have to be decommissioned. The US plants managed to get to close to 60 years before being commissioned, while South African plants are close to 30 years before they collapse. And that's all about correct maintenance. So things aren't looking good at Eskom. We haven't seen any reasons to change the outlook for things to get better. We're still waiting for renewables to come online. There's a major backlog on renewables. We have our infrastructure fund. We're waiting to invest, but things, bureaucracy, red tape, particularly driven by the Department of Mineral Resources and Energy, is leading to a lot of lags. So how moving Eskom into the DMRE can help, I'm not so sure. We'll have to I don't understand the logic in that one. And it's not just Eskom. Unfortunately, Transnet failed to finalize an agreement with their Chinese supplier of locomotives that would have helped to repair trains, get more locomotives and boost capacity on its lines. And the poor Transnet capacity plus the Eskom load shedding is showing. Mining output fell 9% in November. This is on back-to-back after a 10% fall in mining production in October. So really, we can't export if we can't get things out the ground or power, and if we can't get them to the mine. So again, why we stay underweight South African equities. We do have the grey listing coming up in February. And we've also got the budget happening in February. I think the budget is possibly going to be good. Yes, there could be a risk in terms of what exactly is done about Eskom, but generally we're a bit more optimistic on the budget. So hopefully that is an upside risk, whereas grey listing is more of a downside risk. But we do remain overweight South African bonds because of the fact that we think that the budget is going to be decent, and that debt will continue to consolidate, which is good. We also think that the rand is going to move sideways and not weaken too much this year, not because of what South Africa is doing, but because the dollar is likely to continue to weaken. So based on our view of the dollar, we think that it's good to be overweight the rand and South African bonds. So how does that all fit together? Looking at our outlook, so the US, we're expecting a mild recession, but that's only later this year. Whilst Europe is recovering right now as they come out of the worst of the energy crisis. And if there is a recession, it will be at the beginning of the year, Q1. Japan's going to avoid a recession. China, their weakest point was last year, middle of last year. So with all those varying cylinders firing at different times, we think that the world as a whole will have a soft slowdown into 2023, and we remain cautiously optimistic. And we think that the trend of US exceptionalism becoming China resurrection will continue. And because inflation expectations remain anchored, we think that even though inflation is going to stay higher in the US and rates will go higher, it's not going to happen in a fast knee-jerk reaction way. It's going to happen slowly. Inflation expectations remain anchored, and it means that central banks don't have to panic. So with a soft landing, with inflation expectations well anchored, we remain overweight our global equity themes and remain underweight South African equities. Post this very strong rally we've seen now in January, we've actually pulled back our overall equity levels. We're actually slightly underweight equity for the first time in 3 months. Nearly 4 months. And we think that we have rallied really hard. We still think that 2023 will end higher, but in the short term, there could be some volatility just because markets have run so hard. We also think that together with the dollar at 50-year highs, we should see a continued dollar weakening. So now the chart on the right is incredibly interesting. It shows the dollar, the US trade rated dollar, and you can see the small blip as the dollar has weakened from 130 down to about 120, and that's, it feels like the dollar's had a huge amount of weakness, but it's a small blip in the long-term scheme of things. And it's very interesting to see how highly correlated the dollar, trade-weighted dollar is to the performance of non-US equities to US equities. And what you can see there is as the dollar weakens, so US equities underperform. Now, causality is certainly very important here. We don't think, even though there is a small circular reference, it's not a weaker dollar that leads to the rest of the world equities outperforming. It's mostly the other way. It's stronger rest of the world growth. In this case, it's been driven by Europe recovering out of their energy crisis and China recovering because of COVID reopening. And that stronger rest of the world growth leads to rest of the world or non-US equities recovering, which then leads to a weaker dollar. But the dollar itself is also going to weaken just because it's very, very strong. We do think that there are certain US specific risks, like the debt ceiling, but and certainly rest of the world growth does lead to strong commodity prices, which does have a circular reference. But generally, we think it's rest of the world growth that is going to lead to a weaker dollar and non-US equities outperforming. So we remain overweight non-US equities and underweight US equities, and particularly emerging markets in China. Well, I said we are neutral neutral Europe and Japan, overweight South African bonds and the ZAR, the rand, because they will be beneficiaries of a weaker dollar, and they'll be beneficiaries of Europe and China recovering. And those are our biggest trade partners, and they certainly help South African exports when we can get them out of the country. So that's all the positive news. The negative news is that inflation and rates and volatility are likely to remain higher for longer. So we definitely are on the higher inflation for longer camp when it comes to the US. We think that, and the world as a whole, but mostly yes, we think that generally the structural trends towards populism, the structural trends towards US-China tensions, and in particular the drive to develop national champions. And that's not only in the energy realm where everyone's trying to reduce their reliance on importing energy from other countries, driven obviously by particularly Russia and Europe, but also the US is trying to maintain its energy independence of the Middle East. But it's also now moving into the semiconductor space and the global supply chains, trying to make sure that everyone has a semiconductor independence. And it's very interesting, and I'll talk more about it when I talk about the FAANG Fund, but the CEO of Intel, and obviously he's talking his book to some extent, but he says that the next 5 decades are going to be defined by the global supply chains and semiconductor production. And he thinks that semiconductor production over the next 5 decades is going to be more important or as important than oil was to geopolitical risks over the previous 5 decades. So he's saying that semiconductors are the new oil. and making sure that you have semiconductor security is now as important as energy security was over the last 5 decades. So that's definitely something that's going to impact inflation in the short term, and impact pricing, and something to certainly keep an eye out in terms of US and China geopolitical risks. Overall, all of that striving for independence reduces globalization, which reduces growth and leads to increased inflation. So definitely think inflation, while it's going to fall to much more acceptable levels, and maybe 3%, it's not going to get down to the 2%, which is what the central banks have been targeting for quite some time. And because of the higher inflation and the high interest rates, higher for longer, we remain overweight value, we remain overweight healthcare. So pretty much a similar outlook to what we have had over the last few months, and a focus on our global thematic themes. And we think it's just as important as growth this year. 2023 is going to remain low. Headwinds are going to remain from inflation. There are many risks that could arise. And we think rather than hold developed market bonds, rather than hold gold, we still don't hold gold, we still don't hold developed market bonds. We do think that we prefer pockets of growth that are going to be protected, they're going to see their own drivers. And we think that those, we've got sustainable economy. Certainly, there's going to be a huge drive towards renewable energy that will continue even as energy security and deglobalization slows global growth. So the move towards energy security will help renewables and sustainable economy stocks. Similarly, the next emerging consumer, I suppose this is partly aging demographics, but also as partly the move away from globalization is going to mean that different countries are going to try and develop their own national champions, and those national champions will do very well from emerging consumers. And so we like investing in Asia and China particularly, because there will be the next billion consumers will be emerging in that space. High debt is going to slow growth, and that's going to lead to disruptive technologies continuing to do well as they create their own market share and own growth areas. And finally, demographics, which will protect slow growth, but also lead to improved demand in the healthcare space. So let me start with that. I did promise an update on health innovation and the FAANG Fund, so let me get into that quickly. So we think that having a health allocation to the healthcare is a structural overweight in every global portfolio. In a low growth, low return world, it's a safe place to be. It's a safe place to get exposure to growth at passive prices. So low cost exposure to growth that's going to be certainly above global GDP. And why do we think that? Well, the top right-hand chart there shows that the global population is aging. This is from the United Nations, and they estimate that the median age of the global population is going to double by 2050. They're forecasting that the median age rises from 20 in 1970s to 40 in 2050. That's a huge increase in the average age. But the important thing for healthcare is the spending. And the bottom right-hand chart there shows the spending per age bracket on healthcare. And healthcare spending is about 10 times greater for an 85-year-old than it is for a 25-year-old. So the aging populations, and particularly the boomers, are going to lead to a massive increase in healthcare spending. The boomer generation is the largest generation by cohort. It also controls the dominant amount of world's wealth. The boomer population is not only the biggest demographic, but it controls the most wealth. And that the boomers are going to enter the age with healthcare spending rise exponentially this year. The oldest boomers turn 77 this year, and the youngest boomers will reach that age in the next decade. So we've got at least a decade, probably 2 decades, where healthcare spending is going to far outpace GDP growth. So that's our structural overweight for healthcare. In the short term, we think that inflation is going to stay higher for longer. And if you look back over the last 50 years and different regimes, high inflation regimes, low inflation regimes, rising inflation. You see there that healthcare stocks have posted the strongest returns, in an absolute sense, when inflation is between 3% and 9%, and we definitely think inflation is going to stay above 3% or close to 3%. And healthcare has beaten all other sectors when inflation is above 3%. So with the inflation outlook that we've got, we think that healthcare is the place to be in the short term because of inflation, and the long term because of demographics, and is definitely a key part of our global thematics and a key allocation to our global equity portfolios. So every one of our balanced funds, which has a global equity allocation, part of that global equities are invested in health innovation. That's both healthcare and in some cases a small allocation to genomics. And we think that it's important to maintain that. Now, the healthcare stocks, as you saw from my second slide, they were one of the best performers. It's the third best performer over 2022. So people might be reluctant to start buying after a decent return, but in absolute sense, the return was only single digits, and we do think that they're not looking expensive, and that there is more upside to healthcare. Definitely a safer place to hide in 2023. Now, the other exciting thing to look at is the FAANG stocks, and this was, so while healthcare was one of the best performers last year, in fact, it was the best equity performer, and it was only beaten last year by gold and dollar cash. So the best equity sector, the best place to be was healthcare. The worst place to be was FAANG, so the opposite end of the spectrum, and certainly looking very tempting to start to buy FAANG stocks. As you know, we haven't held any FAANG stocks as an additional allocation to our theme. The FAANG is definitely, well, is made up predominantly of some large cap US stocks, and so we do have exposure to them through our index holdings, but we haven't had any additional exposure to FAANG. Now, why do we like the FAANG fund? Why do we think it's an important theme to have and as an available investment? Well, because we think that global platform companies are fantastic business models. They really are. You look at Amazon, you look at Apple, you look at Microsoft, they've got fantastic moats. And it's very easy for them to grow organically. They can very easily add new users, and B, they can very easily roll out new services to the existing user base. So they can organically grow in two ways, which just means it's a strong business model. Now, we've added, in the month of January, we added a new stock that we think will benefit from the global platform growth, and that is Snowflake. Snowflake was seeded and held by Berkshire Hathaway. It was only listed quite recently in the last few years, and is growing incredibly strongly, with revenue up 106% in 2022. And it's going to benefit from the very strong growth in cloud storage and a very strong growth in cloud application. We think it fits well into the global platform theme that's important for this fund. But what's different now is that in the past we've had no allocation to Tesla, as I'm sure you're all aware, and we've had a very small allocation to semiconductors. We had a small allocation to NVIDIA, and it was the only semiconductor exposure we had. Those stocks have fallen very hard. Tesla is down 70% from its peak. Semiconductors are down similar amounts from their peak, and we didn't like either of those just because they generally are very specific focused. They're products, and products don't have as much pricing power as services in general, and it's much harder to add new users or new products, and they're much more held hostage to underlying inflation pressures, as we saw with the supply disruption. So we avoided those stocks, and we have increased our exposure to product providers, we're going to call it. We've increased our exposure to Tesla. We've increased our exposure to semiconductors. We've bought some Intel. We've topped up our, which is a US semiconductor manufacturer, topped up our NVIDIA exposure, which is a semiconductor manufacturer, and we bought quite a big stake in Advanced Micro Devices, AMD, which is a semiconductor manufacturer. So why? Because you might say to me, well, in the short term, surely US semiconductors are going to be hurt by the fact they can't export to China. And yes, certainly in the short term there are some headwinds, and that's why prices are down hugely. But we think that long term, it's a structural place to be. As I said, Intel CEO said that he thinks that semiconductors are going to define supply chains over the next 5 decades and be as important as oil. He thinks that semiconductors are the most critical resource in the world. Now, yes, he's talking his own book, but there is some truth to that. So we think structurally it's a good place to be from long-term growth. Also, structurally in the US, and NVIDIA, AMD, and Intel are predominantly US manufacturers. They're going to benefit by the fact that there's huge support for domestic homegrown champions. The US Chips and Science Act will invest $200 billion into the semiconductor space. And Intel have already come out to say how they're going to spend $70 billion on the back of that, how they're going to invest that money, how they're going to grow the advancement of what they can produce and grow in terms of around their geographical spread, so they can supply all various regions locally. So a huge amount of support for these homegrown champions. A huge amount of support in China for their semiconductor manufacturers, huge amount of support in the US. And while there's some disruption in the short term, and that's why the share prices are off, we think long term that offers some upside. In addition, AMD, you can see there we've got 7%. We think that AMD, as the exclusive provider of chips to Xbox and PlayStation, they'll benefit from the gaming industry. So the gaming industry is definitely a growth indry. I think the gaming industry is likely to grow along with cloud storage. That's the 2 big growth industries in tech that's forecast over the next decade, and AMD will benefit in particular from providing chips to the gaming industry. And AMD also offer data centers, which I think is a structural growth area, as I've mentioned. Now, Tesla's a bit more of a debatable one. I'm sure there are going to be lots of questions that are going to come through and a lot of comments about Tesla. So we haven't held Tesla. It has fallen 70%, and we do think valuations are more appealing, and that's why we have topped up Tesla and bought 4%, still well below the benchmark of the fund, but we think it's time to buy. Because of the fact that it's looking cheaper, and because they have got some great intellectual property. At the same time, we still think there are big headwinds for Tesla. The main issue is that they're moving out of the premium car market into the mass market, so they can no longer charge premium pricing. They need to start taking on VW and Mercedes and Porsche and other EV manufacturers. And that reduction in their pricing power is going to have a huge impact on margins. And they're also seeing that same story happen in China. In fact, in China, China has seen a huge cut in their EV prices of the competitors, to the point where electric vehicles are being sold in China at 10% below the cost of a Tesla. So Tesla needs to make some serious decisions about whether they're going to pull out of the Chinese market or find massive ways to reduce their costs, or sell at a loss. And so there's definitely are some big headwinds for Tesla in the short term, and that's why we remain underweight Tesla from a benchmark perspective. But we do think that there's also a lot of IP in that business, and it has got some exciting growth opportunities once it sorts out its pricing model. So that summarizes the FAANG fund. You can see there the big allocations to the big platform companies: Amazon, Google, Facebook, Meta, Netflix, Microsoft, Apple. Alibaba is still in there which has worked very nicely with some very strong growth. It's also one of the largest platform companies in the world. I know it's very much China focused, but if looking at user numbers, it is a huge exposure, and is certainly benefiting from the China reopening and the fact that China is supporting their tech industry. And then the small allocations to semiconductors, which will hopefully increase over time as we see more positive catalysts feed through into that sector. Okay, so that's it in terms of the presentation. Let's look at some questions. Yeah, first question is from Kubus. He asks, he says, there are rumors the Japanese bond market may unravel and cause a black swan event in the markets. Do you think this can happen? Kubus, you spot on. So in terms of black swan events that can happen in 2023, from the US perspective, it's definitely the debt ceiling from the and a shutdown of the US government and potentially a default on US debt. From the European European side, it's certainly an escalation of the Russia-Ukraine war, and from the Japanese side, it's definitely let's call it a volatile unwinding of their debt targeting or the yield targeting policies. I don't think it's a likely event. They already have, in a relatively sustainable way, they have already moved their 10-year yield target from 0% to 0.5%. And inflation is picking up in Japan. It's forecast to reach almost 4% this year. So we are likely to see further movement on that target. They very recently, the Bank of Japan said that they weren't going to do any changes, but I think we could see a move from 0.5% to 1%. But I don't think it's going to have a massive, I don't think it's going to cause a huge amount of uncertainty or be a black swan event. It's pretty well known risk, and the Bank of Japan has managed that risk so far by moving that target from 0% to 0.5%, and they possibly could move it from 0.5% to 1% if they need to, and that's only if they feel like they're running out of ammunition in terms of buying bonds. At the same time, inflation is going to roll over in Japan, and they might want to just push through until inflation rolls over and not make any changes. But I think that they have they've got two methods of achieving that, and I think that they can do so without a black swan event impacting markets. Alex asks a much harder question. Can you name a few Sygnia funds that you would choose for a discretionary investor for new money for 2023? So Alex, my default for that is always diversify. And we're in our investment team. We run a pick your best fund for 2023, and there's a wide range of views in that. From my side, I've picked China as my fund for 2023. It's had a good start to the year, and I think that it'll continue to do well. Ian Anderson, he's picked the South African Bond Fund as his fund, so a much more conservative view than mine, but it's also doing very well to the start of the year. So and we've all made quite a diverse number of funds that have been picked in terms of the best fund. And it's hard to say which fund is going to do best. It depends on whether how volatile the year is, and where the year ends in 2023. Certainly, healthcare needs to be up there in terms of a more defensive pick. That should be cash. It should be bonds. It should be gold. Might not be the highest return for the year, but it's up there. For people who think that the FAANG is an underdog and that US interest rates will fall, certainly when the US hits its slowdown at the end of the year, US bond yields are going to come off, and that will lead to a rally in US tech. So yes, that rally might be 6 to 9 months out, but that could lead to quite a strong bounce in 4th and FAANG towards the end of the year. We're not topping up those yet, but that could happen then. So I know I haven't answered your question. In terms of our fund allocations, we've got them. We have them all. We've got roughly a similar overweight to healthcare, 4th emerging markets, China, and even value for 2023. So very well diversified, because we think that the defining factor for 2022 is going to be volatility, we're not at this point. We're not prepared to take a big overweight to any one of those themes. So I'm sorry I can't answer your question. All I can say is that my bet's on China, but that's just for our internal competition. It's not for the funds. The funds are well diversified. Louise says, in terms of ETFs, why does the SIG EMF lag so far behind the SIG CN in terms of recovery? That's Louise. It's very much just what the time frame we look at. China fell much harder than emerging markets at the end of last year, just after the Chinese 20th. I forget the name, but when we had the huge political risk, and we had President Xi take on his third term, but China had a massive underperformance, and so China has bounced hard, but it's just coming off a lower base, and China makes up 40% of the SIG EMF basket. So while it does benefit, it is predominantly the biggest factor in SIG EMF. Certainly there has been a slowdown in semiconductors, and that has hurt EM exposure, but not so much, not as much as you would think. So I think it's more of a timing issue, but both have rallied quite nicely over the last 3 months. Sean asked a good question about why there's no appetite for government to fix some of the ESCOM issues. He's talking about municipal debt. Sean, I think the major issue from what we can see is that it's politics. I'm not going to claim I understand the politics, but it's quite simple what needs to be done in terms of fixing ESCOM from a technical perspective. I mean, it's not as easy to execute, but in terms of getting the plan ready, getting experts in, getting renewables up and running, reducing red tape, it's quite simple what step needs to happen. The fact that those steps haven't happened, I can only point to politics within the ANC and different agendas, and that's otherwise why haven't the low-hanging fruit been put into place? Why has load shedding taken so long to be fixed? Yeah, I can only put it down to politics. Andrew asks, Sygnia is underweight South African equities. Yes, Andrew, that's a very recent position. We've used as I said, South African equities are up 10% month to date so far, which is phenomenal. It's done double what South African equities did last year, so we have definitely locked in some of those gains. When you ask, are there any sectors of the JSE that you would consider attractive over the next 12 to 24 months? It's a great question. So certainly the consensus seems to be that resources are going to do really well, that China reopening is going to lead to commodities being driven harder and stronger, and that also support resources. I'm not as bullish on resources as consensus. I think that China's reopening is going to be very much about pent-up demand and pent-up consumer demand being spent on consumer goods. So it's very much a domestic spending, which will definitely help their local economy, but I don't think it's going to lead to a huge demand for resources. And resources are very much based on property and infrastructure, and those seem to be slowing down in the US, in China. So I think that I don't think the resi is going to be the biggest rallier this year. We'll have to see. Financials could benefit on the back of bond yields coming down. We do think bond yields can continue to come down, and at the same time, industrials may be driven further with nice person process continuing to recover, and they've certainly recovered quite nicely from their lows. So again, Andrew, I'm going to plead the fifth on this one, so that we don't actually take, from a fund perspective, we don't take any sector exposure. We invest passively ourselves. Yes, we do invest in active South African managers, and of the managers we use, well, they have a wide variety of views. Some of our active managers are overweight financials, some are overweight resources, and some are overweight industrials. So it's I can't answer your question. I'm just going to go for a diversified view. We're underweight South African equities, and we are invested in the SWIX index funds, and our active managers are pretty much different views depending on who you look at, and that's understandable. They do have different drivers, whether it's growth or value, or their own different time frames. So it's not surprising that they do have. Alan asks, could semiconductor demand be good for fourth industrial revolution? Yes, semiconductor fourth IR is very, very, very diversified. 600 stocks. Fourth IR is going to benefit from a rebound in crypto. So anyone who's bullish on crypto, there is a decent exposure to crypto in the fourth industrial fund, because they do have the distributed ledger index or sub-index, and so the recovery in crypto should support fourth IR. Fourth IR also has a number of indices in sustainable economy, and that we think is going to do very well this year. So that fourth IR will be driven by that. Certainly, the move towards the metaverse is going to continue in terms of virtual reality and VR goggles and those sort of products will continue to do well, so that'll benefit fourth IR. Semiconductors is one of, does fit into some of the sub indices, and so that overall tech recovery will certainly help fourth IR. Yeah, so fourth IR differs from FAANG in that it is more diversified, 600 stocks compared to 12. It's also very US focused, whereas FAANG has more of a global focus. It's the bigger companies which are more globally focused, and does have some direct offshore exposure. Fourth IR also has more small cap exposure, so that there are some different drivers, and we do think that fourth IR is more diversified, and in the shorter term will rally, and that's why we have our tech exposure to fourth IR. We will probably rotate some of that into FAANG in about 6 months, but we've been waiting for that rotation and haven't done it yet. So we'll see what happens over the next 6 months. Sean asked also a good question. Does clean energy tech benefit PGM commodities? Yeah, the PGM commodities will definitely benefit from the move towards hydrogen. Hydrogen is a user of the PGM group, platinum group metals. But that is quite early stages, that hydrogen tech. So I don't think it's going to have a huge impact this year, but certainly it will have a big impact. The shorter term impact is still batteries. If you look at the various metals that go into batteries and how those metals are distributed around the world, it's quite interesting. Roughly, China controls 70% of all the metals that go into batteries. So if you do want to take a view on lithium and the other metals and battery demand staying elevated in the short term, then China is the place to be. Longer term, I agree. I think that longer term, a more sustainable solution to batteries, electric batteries, is hydrogen fuel cells, and hydrogen fuel cells are definitely will support demand for platinum. So maybe a 2025 view. Anonymous attendee says, in 2022, South African equities performed better than global equities. Is Sygnia sticking to their views of being underweight South African equities? Anonymous, you are spot on. It is definitely something that, particularly in the fourth quarter of 2022, South African equities outperformed global equities by more than 10%. Fortunately, we are hedged in that we have underweight SA equities is invested in emerging markets in China, and China outperforms South African equities. So that underweight SA equities view worked for us because of where we invested that position. And we also do think that there was a good reason for South Africa to rally hard, because it was incredibly undervalued, because it is being priced for a failed state. We do still think there is value in South Africa, and I must reiterate that our biggest allocation to every Reg 28 fund is still to South African equities, and that means that South African equities are important to us. We do still think South African equities are going to do well. With the new Reg 28 limits, we could quite easily move our biggest equity allocation in some funds to global equities versus SA equities. We haven't done that yet. So I like to hedge that answer by saying, yes, we are underweight South African equities relative to our benchmark, but our benchmark is cognizant that South African equities still have some value and that it is important to still have a lot of South African equities in our funds. And that's a similar story on US equities, that although we underweight US equities, they're still the biggest part of the MSCI All Country World Index. And so although we underweight, it's still our biggest allocation to global equities. And so, that's those two views are points are important to note when you're considering our active views. Alex, I hope I answered your question of why Tesla is only 4% of the FAANG fund. I still think there are some headwinds in terms of margins, in terms of China. Wayne asks, as the world economy starts to recover, will there be good upside for tech and Tesla? So Wayne, yes, and no. So the world recovery is being driven by Europe, and the world recovery is being driven by China and Japan and emerging markets. The US is the most tech-centric index, and the US is the most tech-centric economy, should I say. The highest portion of GDP is in tech. So the fact that the US is heading towards a slowdown, and the US still has high interest rates and inflation, does mean that there will be some headwinds to tech, and that's why in the short term, we haven't gone overweight FAANG funds, but we do think that towards the US soft landing or recession towards the end of the year, that there could be a very strong bounce in tech, and Tesla as part of that tech when the US is forced to cut rates as the economy slows. Mike asks, if Process is now a good investment? Well, Mike, Process has bounced, this Process has more than doubled since its lows, so it's not as a good investment as it was 6 months ago. Similarly for Tencent or Naspers, but it's still well off its highs, and we still overweight China, as you know, as a whole. Tencent is the biggest. So Naspers and Process invest in Tencent, and Tencent is still the biggest fund by weight in the MSCI China Index. So we do think that it's a good investment. We do really like Naspers and Process management, and we think that there's a solid company, and we think there's still some tailwinds coming from China. So while we don't take any active bets ourselves directly, we outsource that to our active managers, to 91, to Coronation, to Lorium, to Visio. While we don't take us ourselves, we are overweight China, which means we are effectively overweight Tencent from a top-down global macro perspective. Nico asks a good question. What is the difference between Health Innovation Unit Trust and the Sygnia Selective Healthcare 150 Index? The difference is the Health Innovation Unit Trust also has an allocation to genomics and an allocation to Oxford Sciences Enterprises. So it's more diversified. About 90% of it is allocated to the Sol 150 and about 10% to genomics and OSE. Patrick asked the same question, so hopefully I've answered that. Evelyn asks if our slides are available to brokers. Evelyn, the PDFs are available, so please email and we will send you PDFs. Otherwise, the presentation is available on our YouTube channel. Okay, Tom asks a long question, but basically he has concerns about fiat currencies and misuse of fiat money, basically overprinting, and what that's going to do to inflation. And in particular, he mentions aging populations and what that means in terms of paying back that debt. Tom, I'd have to say that it's definitely one of our concerns. and it is the primary driver for our low return, high volatility, low growth environment. So, we've mapped our outlook 5 years ago on Japan, and Japan started quantitative easing 20 years ago. They are the roadmap for high debt. They are the roadmap for aging populations, and they are the roadmap for low growth. Japan, yes, it is certainly some concerns. In fact, what they're doing right now, I'm trying to peg their 10-year bonds at 0.5%, and it is definitely a risk, but they're managing that risk. And for 30 years, they've managed a low growth environment just by taking on huge amounts of debt, and just managing high employment, low unemployment, by taking on debt and building railways and building roads and whatever may be done. So I think that central banks are going to, and Japan printed money basically. And I think that central banks, developed market central banks, that can afford to do that. So as long as there's confidence in developed market central banks, like there has been in Japan, central banks are able to follow the Japan roadmap. They're able to print money, take on more debt, and just spend their way to low unemployment, even though growth is low. So I think that's the base case scenario. If we get to a point where developed market central banks are no longer trusted, and third countries are no longer trusted, well, we could see a run on certain central banks. Effectively, if central banks start being treated as emerging market currencies. And we saw that happen briefly to the UK. When the UK was, when they brought out that rather crazy, very irresponsible fiscal package with taking on huge amounts of debt, the market called their bluff and said, no, you guys don't have the ability, you don't have the exports or your own economy that's strong enough to deal with that. And we saw what happened to the pound. So those risks exist. But I don't think that in general, we're going to see, I think that the US can push through that risk. We think Europe can push through that risk as Japan is, certainly China can. Basically, they're going to kick the can down the road. So yes, there's going to be volatility. Yes, there's going to be issues, but I think that I don't think there's going to be a huge run. Gold is certainly going to benefit more now than it has in the past, just because emerging markets central banks are moving away from developed market currencies and into gold, and so that will support gold. And so yes, the outlook for gold is better than it has been. We still have our valuation concerns in gold, but we do think there's a place for gold, not that we put it into the portfolios. But in the short term, a huge run on developed market fiat currencies, I don't see as 2023 risk. I don't. But as I've said, two of the tail risks are a debt ceiling, and US shutdown. But interesting, looking back when that last happened in the US, the dollar was relatively stable because it's still seen as a safe haven. So the US managed to get away with some rather atrocious fiscal policies because they are seen as the reserve currency of the world. And I think that they'll continue to slowly lose that reserve currency status, but again, it's going to take decades before that properly happens. Peter, hopefully I've answered your. Sorry, Peter. Peter asked if we see a recession in South Africa, what does that mean for our inflation outlook? So we don't see a recession in South Africa. South Africa growth is just going to continue to muddle along at 1.5%. It's going to stay low. It's not going to be great. It's not going to go into recession, and that's similar for our inflation outlook. Growth is so tepid that inflation is not going to. We saw very nice contained core inflation come out yesterday. Core inflation in South Africa 4.9%. We're not concerned about core inflation in South Africa. We're not concerned about a recession. We just think that we're just going to muddle along as best we can with low growth. It's not exciting. It's not terrible. And it's one of the reasons why South Africa did relatively well last year. Is, we were one of the worst places to be, but then the rest of the world slowed down so fast that we were relatively not so bad. But now as the rest of the world recovers, we once again are not going to, on a relative basis, look as good. And so we think that investors will look for higher growth elsewhere, Japan, Europe, emerging markets, and not South Africa, even though we're not going into recession. Morgan asked a great question. What's Sygnia's view on property? From an asset allocation perspective, no change there, Morgan. We continue to be concerned about property, that we don't hold it as a separate asset class locally. We do hold it as a separate asset class globally, but locally we don't, partly because the Swix index has a 6% allocation, 5-6% allocation to property, so there's no need to do so, and partly because we still think there's big headwinds to property. In the short term, it's very much rising interest rates. So generally property stocks are 40 to 60% geared, and those debt servicing costs are going to quadruple over the last, or have quadrupled over the last year, and it's going to feed through into earnings. And there are still, there's still various supply demand imbalances as a result from work from home that need to happen, and at the same time, the huge costs of load shedding, and some rental companies pass it on to tenants, but even then, even if they do, the tenants are making losses, and the revenue share impacts rental growth. So we're not going to see great returns. Yes, the property stocks are looking cheap, but they're looking they remain cheap for a reason. Mike asks what the annual return is for the income maximizer fund. But Mike, it's a good question. I should have mentioned that, but yields are still looking decent across, in fact, all our income funds, because interest rates have gone up. The enhanced income fund current yield, so that's the current yield, that's the yield we expect over the next 12 months if interest rates don't move, if the yield curve and bond yields don't move. So assuming no movement there, you're looking at about 9.5% on enhanced income fund, about 10% on income maximizer, and about 10.5% on bonds. So some incredibly amazing real yields on South African income funds, bond funds, and that's why we do overweight to that sector. If bond yields continue to strengthen, which we think they will on the back of a stronger rand because of a weaker dollar and because of a decent budget, we think that we could have some capital gains on top of that in the bond funds and income maximizer. But that has to be balanced with the risks of further load shedding, and what that does, and tail risks that could happen at the budget. We don't think they'll be there, but there could be some tail risks that sneak into the budget in terms of expenses that we aren't planning to see. Marcus says, the South African government has stated that our power issues will be a thing of the past in 12 to 18 months. Marco, he asks what the probability of that being true. I'm pretty sure that those promises have been made over the last 15 years. So I wouldn't put much weight behind any promise that comes out of any politician in general. But that said, certainly, despite the ongoing bureaucracy, and despite the ongoing red tape, and despite the government doing its best to fight itself and avoid fixing the problem, we are starting to see incremental changes. And one of those was firstly raising the cap on self-generation to 100 megawatts. And then much later, the removing of the license requirements at the DMRE so that self-generation could go ahead. Because even though the cap was lifted, the DMRE continued with its bureaucracy and continued to try and stall any renewables. It seems to be, if you read the Daily Maverick and other sources, it seems to be assumed that Gwede Mantashe is not a fan of renewables, and he is still a big fan of coal. So I suppose the higher his influence, the longer it's going to take to switch into renewables, which is obviously one of the solutions, and that is a solution. But right now we're not seeing that. So right now, from our perspective, what we are seeing is we're seeing big bids come in from the large industrial companies and large mining companies who are trying to build their own solar plants and trying to move off the grid. So I think in the short term, over the next 12 to 18 months, the only saving grace is going to be South African consumers moving to solar on the residential, and South African big companies, the large cap mining stocks and industrial companies moving also off the grid. And to that extent, it reduces the demand for electricity, then that will help stabilize things. And I think there's a high probability of that. We've seen huge amount of demand for that from those big companies in South Africa. And installing solar is quick. Anyone who's put it into their house will know, but even putting up massive wind farm plans or massive solar plans is very quick. The hard part is connecting to Eskom. The hard part is Eskom transmission. The hard part is government bureaucracy. But for a mining company or industrial company to put up the solar plant on site, they can do it incredibly quickly. So I think we can reliably bank on the fact that demand for Eskom is going to fall quite rapidly, which should help to some extent. For the rest, we'll have to see what happens from a political perspective. Certainly, there's the ability to do it, and we just don't know how willing that various parties are to achieve agreement. I said in the past that surely the ANC knows that there's a national election coming up in 2024, and surely the ANC knows that they have to get load shedding fixed and to by then to make sure that they win back some votes. But just looking at the toing and froing that's happened since we entered into stage 6 3 months ago, the lack of response, the lack of a cohesive plan is quite worrying. So hopefully we're surprised the upside. But yeah, I think most people are getting their own backup solutions put in place. Dave asks my favorite question. He says, are you a big fan of Skeleton 70 fund? Yes, Dave. So I've said it before, it's my favorite fund, Skeleton Balance 70. I have my entire RA in that fund. I think it's wonderful. 35 basis points plus VAT, and you get exposure to all our global themes. Our overweight allocations to global themes, our overweight allocation to bonds, and I think it's South African bonds and proper risk, top-down risk management. I think at that fee, and 0% RA fee on top of that, that's quite fantastic. Now we are going into, sorry, I see we are low on time, but we are going into tax season. So from a tax season perspective, it's very important to look at RAs. We will be having a webinar on the first week of September. We'll be talking about some of our funds and some of the best way to make sure that you maximize your end of year tax benefits, whether it's a tax-free savings account or retirement annuity. And I'll also be talking about the two-pot system, because I think that's quite important. And two-pots is very exciting. Two-pots is basically a new type of tax-free savings account. There's all sorts of nuanced differences, but it's another way of saving without paying tax in South Africa. And I'm sure everybody right now feels that they shouldn't be paying tax in South Africa because they're not getting anything for it. So yeah, it's good to try and maximize your tax efficiency. Peter asked how the S&P 500 will do this year. Well, we remain underweight the S&P 500 because we do think that we'll see some dollar weakness and other risks. But yeah, on a whole, we don't think, as I said before, some market commentators are forecasting 50% falls in S&P 500 because of, say we're going to see the same lows that we saw in the 1970s because of crazy interest rate hikes. I don't see that. Yes, we see a mild recession. Yes, we see the Fed continuing to increase rate hikes. But I think, and I suppose this is the key point, we think that the Fed is going to actually accept higher inflation for longer. Yes, they'll carry on hiking, but they'll accept higher inflation for longer, which means they won't cause huge drawdowns in the markets. The markets will recover from those drawdowns. So while I think there will be a decent drawdown in the S&P 500 this year, I think it will also recover. Marcus says, if unrestricted by legislation, what would Sygnia's offshore allocation today be on the retirement funds? So no change. We are not, the offshore allocation is 45%. We're not at 45%, so there is no change there. And the reason for that is there is still value in South African equities. There's still massive value in South African bonds compared to developed market bonds. And our liabilities, when it comes to doing all the modeling, the liabilities and our retirement is in rands. Carl asks, what's the view on the OSE fund? We do think there's some exciting outlook to OSE fund. There should be a newsletter from OSE coming out mid-Feb, and all the juicy details should be in that. Yeah, anonymous. We don't think, as I've mentioned, we don't think there's going to be a massive crash, the same crash we saw in 2008 towards the end of this year. We think that we're still in a muddle through, and I think that's been our view for the last 5 years. At least there have been some big pull downs in the last 5 years, but our view is very much purgatory. That central banks are going to avoid a recession. A depression, because no one wants that. They're going to focus on employment as well as inflation, and we'll have pullbacks, but not anything that's going to break economies. Sean asked if South African equities are not a value trap. That's a very, very, very good question. Fortunately, 70% of the top 40's earnings are from outside of Africa. So although South Africa could be a value trap, the JSE is definitely less so. A good question on our view of SWIX versus cap SWIX. Yes, we still prefer SWIX. And SWIX has got a high allocation, not large, but a 2% high allocation to mass and process. So we do like China. So that's why we're happy to be in the SWIX. But generally, we like the SWIX because of the construction methodology. Now, what is very interesting, and we'll probably have a webinar on this later on in the year, but the JSE is redoing all their indices once again. So JSE loves to do this. They keep churning out new indices. They keep changing those indices. The cap SWIX has had its cap changed 4 times over the last year. And every time there's more churn, there's more trade on the JSE. It's a fantastic business model. The JSE is currently in discussions with the industry about combining the SWIX and the ALSI. So we will have, instead of having 4 indices, ALSI, capped ALSI, SWIX and capped SWIX, we'll only have 2. Basically they'll have a similar methodology to SWIX and capped SWIX. But even in that case, we will stick with our SWIX because we think that less churn is better. Lower costs are better. George asks, will the Sygnia living annuity offshore allocation remain at 45% for the foreseeable future? Certainly. That's the general cap for the industry. So we think it's a safe place to be fair to everybody. So we will be sitting at 45%. And that, I'm pretty much out of time now, past 12:30. So unfortunately we have to go, but thank you everybody for your questions. It was great to be with you again. It was great to give you our views, share our views, and to hear from you. So thank you so much for joining and participating. And yes, all the best for 2023. Cheers.